Hi, my name is Evie. I'm the founder of Smart with Money Planning, and right now I'm going to talk to you about why a Roth IRA is better than a traditional IRA. So we hear it all the time, Roth IRA this, Roth IRA that. What's so different about a Roth? Well, basically, if I got paid now and it's money off my paycheck, it's already been taxed, and then I put it into a Roth, it will never be taxed again, assuming that I qualify for a Roth. What does that mean? If you make over 135,000, you cannot you cannot contribute to a Roth directly. We'll talk about how you can get a Roth IRA later. And if you're married and your combined income is 199,000, you file married filing joint, right? You're ineligible for a Roth. You make too much money. So what's the difference between a Roth and a traditional IRA? A traditional IRA, if I took money from my paycheck and I contributed to that traditional IRA, then I don't get taxed at that point. So if it's a deductible traditional IRA for me, then I would actually get to deduct what I put into that traditional IRA, $5,500 a year. But when I'm old and I'm just trying to enjoy my life, I'm not trying to deal with paying taxes. All of the growth in that IRA that I've had, a traditional IRA, right, will be taxed when I withdraw, when I take distributions. And you have to take distributions with the traditional IRA. There are no required distributions for a Roth IRA. Why? Because the government has to get their tax one way or another. They get their tax on the front end, the Roth IRA, so they just cut you some slack. Your account could just keep growing and growing and growing. You get 10% a year, 10% a year, 10% a year interest, and it compounds and compounds. You keep contributing to it. When you're old, you want to take it out, it's tax free. Traditional IRA, you didn't pay tax on the front end, but then all that growth, not only are you paying tax on the amount of money you put in, but you're paying tax on the earnings growth too. Um, so if you put $100 in it for simple math, and then you got 10% interest, now it's $110. With a traditional IRA, you're paying tax on $110. But with the Roth IRA, you put $100 in it, you got taxed on that $100, but then let's say it grows 10%. So maybe you got taxed, we'll call it 22%. So it drops to $78, right? But now it compounds 10%, and that's about, it brings you to about $85. Then it compounds 10%. Now, excuse me, you're looking at about $93. And this is over the course of tens of years, decades for most people. So you really would benefit most if you saw a financial projection. But at the end of the day, all you have to remember is um, tax today with a Roth, but not taxed again ever. With a traditional IRA, you're taxed later, and the government will likely get more money when they tax you later. Another good thing about a Roth is that you can actually use it similar to a savings account, but don't use it as your savings account. If you have money in a savings account and it's a rainy day, right? You take from that savings account if you can't take from the checking account. Then you can take from a credit card, swipe on a credit card if you're able to, and make sure you pay that back as soon as possible. But so when would you take for a Roth? Well, you can take money out of a Roth for a first time home purchase, up to 10,000 for the down payment. You can also take money out of the Roth for grad school, if you have a permanent disability, if you have unreimbursed medical expenses that are over 10% of your adjusted gross income. So, a really unfortunate expensive surgery or accident, something of that nature. You can also take money out your Roth to pay back taxes. There's a lot of flexibility with a Roth. One good thing that a lot of people overlook is that you can donate your Roth to your heirs tax free. So let's say you have so much money that you don't even need to take money out of your Roth. Well, guess what? You can just um, basically gift your Roth to your heirs, and they won't have to pay tax on it, and they will love you forever, right? That will be the legacy that you leave them. So I said I would talk about the backdoor entry. Basically, if you have over an income of over 135,000 adjusted gross income, single, 199,000 adjusted gross income, married, filing joint, what you do is you get a traditional IRA. It's non-deductible, right? But when you convert to a Roth, you have to calculate the taxes that would have been taken out. And then if you didn't already pay those taxes, right? Now you convert to a Roth, and then you have the same earnings growth benefit. And that's the key. Earnings growth, which if you ever looked at a projection of how interest works and compound interest works, then you would see that that's a big deal. That's how some people end up with millions of dollars or $1 million nest egg. It's because of the earnings growth, the interest that you get on top of the interest, and then you get interest on the sum of that, so on and so forth. And the limit, once again, is 5,500 per year for regular people. If you're over 50, it's 6,500, which is the $1,000 extras, what's called a catch-up distribution. But if you can open a Roth IRA, you go to Fidelity, Vanguard, whatever broker, and just pick it out. A Roth IRA, if you're under 135,000, and then now you're like, okay, what am I supposed to invest in? My Roth IRA is invested in mostly the S&P 500, about 80%, and then you can maybe pick some high income funds in there, and you can do a lot of different things with the Roth IRA. You can actually, the Roth IRA is like a wrapper. It's similar to a physical wrapper, but it's abstract. Of course, it's not a physical wrapper. It's just a legal classification that encases the investments that you choose. So that's how I would describe it. There's two aspects to it. You open the actual, you say, hey, I declare this account to be a Roth IRA account online through your broker, and then you say, do you just want to put cash in there? Well, that defeats the purpose of the Roth, right? The key to the Roth is the growth, earnings that's tax free. So how do you get that growth? Well, S&P 500 this year grew about 19-20% this year. On average, historically, it's about 10%. So S&P 500, top 500 biggest companies by market cap: Coca-Cola, McDonald's, Walmart, Amazon, so on and so forth. And due to capitalism, it's usually smart to invest a good chunk of your money with the winners. The rich become richer, right? So that's why, that's how you would invest the Roth IRA. And if you have any questions, let me know.